In this video, I'm going to show you the journal entry a company would make when it collects cash from a customer. Now we're actually going to look at three different scenarios. When a company makes a cash sale, when it makes a sale on credit and then collects the cash at a later point in time, and then when a company collects the cash immediately but is not able to record sales revenue just yet. So let's start with the simplest scenario where we just have a cash sale. Say the company sells some inventory that originally cost the company $60 for $100 cash. The company would debit cash for $100 and then it would credit sales revenue for $100. But also the company is selling inventory that had a cost of $60, so it needs a debit cost of goods sold for $60 and credit inventory for $60. Now over here, I've got a similar scenario, but where the company's not selling inventory, it's selling services for $100 cash. In that case, we would debit cash for $100 and then credit service revenue. So you see that the company is immediately receiving the cash and immediately recognizing revenue. Okay, so that's the simplest scenario. It's a little more complicated when we have a credit sale. Okay, so we're going to discuss an example to a credit sale, but let's again say the company is selling inventory that had a historical cost of $60 and it's selling it for $100, but this time the company is not immediately receiving $100 cash. So now, instead of debiting cash for $100, the company is going to debit accounts receivable. But the journal entry is otherwise the same, right? We're going to debit cost of goods sold, we're going to credit sales revenue, and then credit inventory. Now, if the company were to sell services on credit, we're not going to have debiting cost of goods sold and crediting inventory because there is no inventory, but we're still going to debit accounts receivable and credit service revenue for $100. The company has not collected the cash yet. When they later collect the cash, they have to make another journal entry. Okay, so when they receive the cash at a later point in time, they're going to debit cash for $100 and they're going to credit accounts receivable for $100. And that's going to be the same journal entry, whether they had originally sold inventory, whether they had originally sold services. In either case, at some point later, they receive the cash, they debit cash, and they credit accounts receivable. Now, I'm going to ignore the scenario, which some companies will offer a discount for early payment and things like that. So we're going to ignore that because I have other videos on that. Okay, so let's just assume there was no discount for early payment or anything like that, so they just received $100. Now, the final example, we're going to have unearned revenue, where the company is receiving cash from a customer up front, but the company cannot record the revenue yet. So in the scenario with the inventory, for example, well, we could just say that, well, the company has not delivered the inventory to the customer yet. And with this example with the services that we talked about before, we just assume the company has not provided the services yet. So this is just a scenario where the company has received the cash, but it has not done yet what it is supposed to do to be entitled to recognizing this revenue. So in each case, what we're going to do is basically just the company's receiving cash, so it's going to be debiting cash for $100, but it's going to credit unearned revenue. Remember, unearned revenue is a liability, okay? And this journal entry is going to be the same whether we're talking about physical inventory, whether we're talking about a company that sells services like a law firm, because remember, the company, there is no journal entry here relating cost of goods sold or inventory or anything like that because the company has not delivered the inventory yet. The inventory has not been affected. So whether this transaction has to do ultimately with physical inventory or services, it doesn't matter. For the initial journal entry, the company is receiving $100 of cash, and then it's crediting this liability account unearned revenue.